Good morning, students. Welcome back to the session on accounting. So today we are going to start with a new topic that is about consolidated financial statements. First of all, we will talk about the concept in relation to this consolidation, and then we'll also discuss the principles of accounting, or we can say the principles of consolidation. So now, what are consolidated financial statements? And what is this concept of consolidation? Let's try to understand. When it comes to the preparation of the financial statements, which most of us are familiar with, it means that we are preparing their balance sheet, their P&L, we are preparing their cash flow statement, and all of these components which are required to be prepared for a financial statement. But that is something we do only for a company. So let's suppose we have a company H Limited. Now, when we prepare their financial statements, it will include balance sheet, P&L, cash flow statement. But that will be the financial statements of this company only. Let's suppose over and above this company, we also have two more companies. Say S1 and S2. These two are companies, okay? And both of these companies are the subsidiaries of H Limited. So H Limited has got control over S1 and S2. H Limited has got control over S1 and S2. Now, how do we see the control? Control is wherein the financial operating decision making in relation to the group companies or these two companies S1 and S2 is through H Limited only. Means H is the one who is involved in driving the decision making. Who is involved in driving the decision making of the subsidiary companies. Okay. Now, in such a scenario, there could be a lot of transactions which may take place between these companies. Say there could be transactions between H Limited and S Limited and S1, and there could be transactions between H Limited and S2. Or there could also be a lot of transactions between S1 and S2. And let's try to understand the rationale behind this. Say, for example, a company wants to expand its business. So, what are the ways of expanding a business? This would also be through diversification, or this could also be through entering into various geographies, wherein the company may decide that instead of bringing in this additional business, the company will set up new entities in the form of a company only, and that new entity will be involved in that additional business venture or a new business venture. Correct? Now, if let's suppose one has to look at the picture of how this entity is performing, or how this shareholder, okay, or the shareholder of H Limited wants to assess the performance. So what should he ideally do? He should not only look at the business performance of this company, he should be looking at the business performance of the entire group. And why? That is because of the fact that these two companies are no different from H Limited, because these are eventually controlled by H Limited. Because the profits which these two companies will generate, that will also belong to H Limited only. Why? Because H Limited is the shareholder of S1 and S2. So whatever earnings S1 and S2 will generate, that will go to H Limited, and from H Limited to its shareholders. Correct? Yeah. So that's why whenever we have a situation of such a structure, wherein over and above one company, we also get to see some of its subsidiaries companies, then instead of looking at the standalone financial statements, okay, so the financial statements that we prepare for this company are what? Standalone financial statements. So instead of looking at standalone financial statements, we should be looking at the financial statements of entire group. So which means we need to combine these three, and then we should be preparing the financial statements. So that means financial statements of entire group. Financial statements of entire group. Now, what does this group comprise? This group comprises of H Limited, S1 and S2. Now, whenever we talk about a group, for our purposes, it will always include holding company and the subsidiaries companies. What do we mean by subsidiary companies? Subsidiary companies mean the companies which are controlled by another company. And what do you mean by holding company? Holding company would mean the company which has control over other company. Understood? Yeah. So for our purposes, in our example, this H Limited is what? This is nothing but a holding company. And what are S1 and S2? They are subsidiaries. So this is a subsidiary. Similarly, if you look at S2, S2 is also a subsidiary. All right. Yeah. Now within a group, and for this to be called as a group, it will be essential that at least one holding and one subsidiary is there. We may also have more than two subsidiaries. So it's not that we are limited to only two subsidiaries. We may have a situation wherein subsidiary companies could be 4, 5, 10, and so on. But it has to be at least one. Only then it will become a group. So that means at least two entities should be there for this group to be called as a group. Yeah. Now, whenever we prepare the financial statements of the group and not the company only, such financial statements technically are termed as consolidated financial statements. So you can say these will be termed as consolidated financial statements. Financial statements of the group, you can say, are termed as consolidated financial statements. Now let's try to understand what do you mean by consolidated financial statements and how are these consolidated financial statements different from the financial statements of a company. So that means how are these different from standalone financial statements. And this is, I would say, the most important principle for our understanding in relation to consolidated financial statement. Because if you understand this concept clearly, then most of the problems in relation to consolidation which you generally face or which you might have heard of will automatically go. So that's why I need your attention now. See, whenever it comes to the group or whenever it comes to the preparation of consolidated financial statements, you always need to remember one fact. That the financial statements that you prepare, okay, for a company and the financial statements that you prepare for a group are no different in terms of principles of preparation of financial statements. Yeah, so I'm repeating my point. I'm saying let's suppose if you were to prepare financial statements of a company, then the same principles of preparation of financial statements you'll apply for preparation of financial statements of a group. Okay. The only thing that you need to remember at every point of time is that whenever it comes to the group or in relation to the group, you will not consider as if these are three different entities. No. You should forget as if you have got three different entities. You should consider all of them as single economic entity. I'm repeating my point. I'm saying instead of considering these three entities as different, you should assume, you should consider as if it's one entity. And then you prepare the financial statements of these three combined entities. Okay. Wherein the term which I have used is called as single economic entity. Single economic entity means you are considering all of them as one instead of three. The moment you will have this thought, wherein you will forget that these are not three but one, most of the requirements related to consolidation will automatically get resolved. And let's try to understand some of those principles one by one. Okay. So let's try to understand how do we prepare CFS. So I'm not getting into the detailed principles now. I'm just touching upon some of these points. And we'll also compare this with standalone financial statements. Now, whenever it comes to the financial statements, what do we have? Balance sheet, P&L, cash flow statement, right? Then we have notes to accounts. Okay. So now, when it comes to the preparation of consolidated financial statements, so now what are going to be the components of financial statements? What are going to be the components of financial statements? You can just start sharing your thoughts. Yes. Again, it will be same. Balance sheet, P&L, cash flow statement, notes. As you can see, all the components of financial statements which we had in standalone are the one which will also be there in consolidated. And there is no additional component of financial statements in case of consolidated financial statements. The only thing is that this balance sheet which you prepare is now called as consolidated balance sheet. This was called as standalone. Okay, this will be called as consolidated P&L instead of standalone. This will be called as consolidated cash flow statement instead of standalone. These will be the notes to accounts to consolidated financial statements instead of standalone. Yeah. So you can now understand that if you already know how to prepare the financial statements, then it's not something which is new, which is required to be done. It is exactly the same. So whatever you were required to do earlier, in a way you are now only going to practice that in terms of preparation of financial statements. Correct? Yeah? Understood? All right. Moving further. And moving on to that principle of single economic entity, let's try to go back to the preparation of standalone financial statements. I'm sure you know about preparation of standalone financial statements. Correct? Am I Am I correct when I say that you know how to prepare the standalone financial statements? All of you quickly respond. Am I correct? Yeah, all of you know about preparation of standalone financial statements. Yeah, I'm waiting for the responses. Okay, all right. So now, let's suppose you are preparing financial statements of H Limited only. For the time being, I'm just moving away from consolidation. Okay. Let's suppose if you were preparing financial statements of H Limited only H Limited, okay, and you know that H Limited has got two branches. H Limited has got two branches, and there have been transactions between those two branches. There have been transactions between those two branches. So when you prepare the financial statements of H Limited, can any of you tell me quickly, how will you deal with those inter-branches transactions? Yes. Okay, great. So I started receiving responses. All of you know about preparation of financial statements. Very good. Sharon, I think is not very clear on the preparation. Okay, no problem. Sharon, anyways, you'll understand about those points. Okay, now, quickly, if you can tell me, how do you deal with preparation of financial statements when it comes to the inter-branches transactions? Yes. Kamal is saying it will be no effect. Okay. Manish is saying like dependent branch in branch accounts. So can any of you tell me how will you deal with those inter-branches transactions? Quickly, I'm waiting for a response. How will you deal with that? Okay, very good. So Sanjay is saying eliminate the unrealized profit. Manish is saying, sorry, Aditi is saying eliminate those transactions. Great. Gilbert is saying inter-branch transactions are eliminated. Correct. Great. And can you tell me why do we eliminate? Because we need to present the picture of the company only. Any transactions which are taking place inside the company and which are not with the external parties are not reflected in the financial statements. Correct? Yeah, that's the logic. That's the logic of eliminating inter-branches transactions. Yeah. Okay. Now, let's try to apply the same principle over here. We'll apply the same principle. So I can see a lot of responses coming up. Great. So Mishna is also saying same thing. Jamil, Nakul, Anant Raman, they are saying we need to eliminate. Very good. Okay. Now, applying the same principle over here, that means the one which we just discussed for branches. Let's suppose H Limited has got some transactions with S1. And S1 has got some transactions with S2. S2 has also got some transactions with H. So we can say there are intercompany transactions. Transactions between the company. Now, what is it that we need to prepare? We need to prepare financial statements of the group. We are not preparing for the company. And what is the group? Group is this one. So these three companies taken together form a group. These three companies taken together form a group. Let's suppose if S1 has got any transaction with M1 or say M limited. If let's suppose S1 has got any transaction with M limited, will this be considered as a transaction within the group? No. It's a transaction which is outside the group. But any transactions between these three companies internally are the transactions within the group and not outside the group. So that's why when we prepare the financial statements of the group, wherein we consider all the group entities as one entity and not various entities. So what should we do? We should eliminate any transaction which is taking place between the company. Means any transaction which is taking place inside the group should be eliminated. Correct? Why? Because even though it's a transaction outside the company, but that is not outside the group. So for us, now what would matter? Whether the transaction is outside the group or inside the group. So now the way we need to look at will not be the company, will be the way as if this entire group comprising of various entities is one entity. Understood? Clear on this? And it becomes now simple and easy to understand. Because you will be thinking that in a way, sir, can we treat these two as branches only? Of course, yes. In relation to this principle, it's the same thing. Yeah, clear? Okay. Now, this becomes the basis for you to consider this group as single economic entity. Yeah. In relation to this principle of single economic entity, there are some more principles which you will require to consider and which we'll discuss as we move further. But this is a very, very important point. Please remember, this is a very, very important point. That is considering the group as a single economic entity. If you remember this point, then most likely you will not face much of the challenges when we'll discuss consolidation. Otherwise, you will keep getting confused at various points of time as to why we are making this adjustment, why we are making that adjustment. All right? Yeah? So now, in case you have got any questions, any doubts, please tell me. So now I'll move further. So we have just touched upon the concept related to the group, subsidiary company, holding company. What is a group? How is it relevant? What is the need for preparing the consolidated financial statements? Yes. Any questions, any doubts which you may have, please let me know. Okay, clear on this? All right. Now, we discussed about subsidiary companies, S1 and S2. Now, please remember that for the purposes of consolidation, these companies may be Indian subsidiary or foreign subsidiary. Why I'm saying Indian or foreign? Because we are talking only in the context of set of financial statements in India. So that's why I'm calling it as Indian subsidiary or foreign subsidiary. So it is not necessary that the subsidiary company has to be in India. Even if a subsidiary company is outside India, same accounting principles will have to follow. Okay. Number two, when it comes to the control, we understand that H Limited is the shareholder of S1 and S2. Now, this shareholding of H Limited in S1 could be 100%, and the shareholding of H in S2 could be, let's suppose, 80%. So, it is not necessary that H Limited will have 100% shareholding in all of its subsidiaries. Because for a subsidiary, 100% shareholding is not a must. Yes, the shareholding has to be greater than 50% for Indian GAAP. Now, whenever you will have a situation wherein H Limited holds 100% shares of S1, such a subsidiary will be called as wholly owned subsidiary. So this subsidiary will be called as wholly owned. Wholly owned means wherein 100% shares are held by holding company. But if you look at S2, 100% shares of S2 are not owned by its holding company. 100% shares are not held by its holding company. Some portion, what's that some portion? 20%. 20% shares of S2 are held by other companies, or you can say other shareholders. Other means other than H Limited. Okay. This is a scenario of a partly owned subsidiary. So in this scenario, what do you call S2 as? Partly owned subsidiary. So this is partly owned subsidiary. And please remember the fact that this subsidiary and this subsidiary would be in India or outside India. It doesn't matter to us. For us, we need to ensure that these two have to be subsidiaries always. Okay, clear? Now, as we discussed, for S2, 100% shares are not held by H Limited. Some portion of its shares, what was that some portion? 20% of its shares are held by other shareholders. Now we are not sure whether it's one shareholder or we have multiple shareholders holding 20%. We are not sure about it. The only thing that we know over here is that when it comes to S2, majority of the shares, what is the majority? 80%. If you look at majority of the shares are held by H Limited. And minority, what do you mean by minority? Other than majority. What is minority? Of course, 20% is minority. Some portion which is held by other shareholders, what do you call it as? Minority. Or you can say interest of minority in this company. So this 20%, for the purposes of this accounting standard, a term has been assigned to this. And what do we call it as? Minority interest. Minority interest. So these 20% shareholders are termed as minority interest. Okay, clear? Yes? Okay, Jameel has a query. Jameel is saying that holding company should be an Indian company only? Yes, of course. Because who will prepare consolidated financial statements? Group will prepare. And within the group, who will prepare? It's H Limited. So in fact, if you look at H Limited will prepare two sets of financial statements. One, that will be standalone. Means financial statements of H Limited only. The way it was done earlier, it will continue. It will not stop. Along with this, H Limited will have to prepare another financial statements. And what is that called as? Financial statements of group. Or you can say CMS. Okay. And this is something which is only required to be done when H is in India. Because if H is outside India, We are not bothered about it. Okay, clear on this? Mohammed Shamim is asking, sir, annual return consolidated financial statements are filed or standalone financial statements are filed to ROC? Yes, both of them are filed to ROC. Kamal is asking, sir, if a company holds 40% shares and is a major shareholder, then will it be a holding company? No. For your purposes, you should always remember that for a company to become holding company, the shareholding should be more than 50%. Only then it will become a holding. Okay. Or you can say only then it will become a majority shareholder for the purposes of consolidation. And whose minority? Minority has to be less than 50%. Always. Okay. Clear on this? Minority, majority, you are clear? What is partly owned subsidiary? What is wholly owned subsidiary? What is a group? Who is holding? Who is subsidiary? What are the components of financial statements? See, all of these terms, they set the underlying principles for us to move into consolidation in detail. So that's why it's very, very important to have an understanding about all of these terms. So if you have any doubts, any confusions in relation to any of these points, please let me know. Okay. Okay, Sakshi is clear on this. Shuna is clear. Jamil is clear. Okay, great. So now, moving further on to the requirements related to consolidation, wherein we have discussed as to what is the basis of consolidation. Now, question may arise that is this consolidation mandatory, or is the preparation of consolidated financial statements mandatory? For this, you should understand one principle, that now, as per the requirement of Companies Act, consolidation is mandatory. Okay. So consolidated financial statements have to be prepared always. The moment we have holding and subsidiary, I'm not talking about associates and joint ventures. The moment we have holding and subsidiary, consolidation is mandatory. Means consolidated financial statements will have to be prepared. However, there is one exemption which is available, which we can discuss now. Now, please remember that this exemption that we are now going to discuss comes from the Companies Act. Okay, this exemption comes from the Companies Act. So let's understand what is the exemption. Say, for example, we have H having 100% shares of S, and S has 100% shares of T. Okay, and T has what? 3 subsidiaries: L1, L2, L3. Yeah, okay. So now if you look at T has got three subsidiaries, L1, L2, L3. Now the question arises whether T should prepare consolidated financial statements or not. The answer is yes. T has to prepare consolidated financial statements. So that means CS is mandatory, CFS is mandatory for T. But there is one exemption which is available, using which if T wants, T may not prepare consolidated financial statements. I am repeating this point. If T wants, T may not prepare consolidated financial statements. So it means that even though it's an exemption, it's an option available to T. This exemption doesn't stop T from preparing consolidated financial statements. This gives T an option not to prepare consolidated financial statements if T doesn't want. Okay, clear? So that means it's not mandatory. It's optional on the part of T. If T wants to prepare consolidated financial statements, then it's fine. Otherwise, no. So let's understand what is this exemption. Number one, T should be subsidiary of another company, which is the case. So currently we have T as a subsidiary of S. Now T may be subsidiary which is wholly owned or partly owned, it doesn't matter. Number one. Number two, if you look at S, S is the holding company of T. If you look at S, S is the holding company of T. If you look at H, H is the holding company of S. H is the holding company of S. Correct? Yeah. H is the holding company of S. Now H controls S and S controls T. Or you can say T is controlled by S and S is controlled by H. So indirectly, T is controlled by H only. So in this case, if you look at the parent company of T, who's the parent? Who's the holding? S. But who's the ultimate parent? Ultimate holding company? It's H. It's H. Correct? So the ultimate holding company of T is who? H. So this is the ultimate holding company of T. So now, coming back to the exemption, T should be a subsidiary, which is the case number one. Number two, holding or the ultimate holding of this subsidiary should have this consent that if T doesn't prepare consolidated financial statements, it is okay. Means T should have the consent of S, H of not preparing the consolidated financial statements. Yeah. Number three, T should not be listed company and should also not be getting listed. Means T should not be a listed company and should also not be in the process of getting listed. Number four, either the holding company of T or the ultimate holding company prepares consolidated financial statements which are filed with the registrar. I'm repeating all of these points. Now, please remember that all of these points, all of these conditions which I have specified, all of them have to be met. Only then the consolidation can be exempt for T, otherwise not. And when I say exempt means T will have an option not to prepare consolidated financial statements in such a scenario. First, T should be a subsidiary. Second, ultimate holding of T should have the consent that T doesn't prepare consolidated financial statements. Number 3, T should not be listed and should also not be in the process of getting listed. Number 4, H or S prepares consolidated financial statements which will be filed with the registrar. If all of these conditions are fulfilled, then T may not prepare consolidated financial statements. It will be okay. Clear on this? Yeah, all of you clear on this? Now I have got some queries from Manish. Manish is saying, sir, H Limited will have liability towards minority shareholders for FS. Yes, we'll talk about it in some time. Namrata is asking, sir, if a company holds 50% shares and B company holds 50% shares of C. So Namrata is saying A holds 50% of C and B also holds 50% of C. Then which one is subsidiary and holding? See, this should be a case of a joint venture instead of holding subsidiary. Ramakrishna is asking, sir, if 50%, then who will prepare? As I told you that for a holding company, it has to be more than 50%. Manish is asking, sir, in this example, if let's suppose T is listed, then it is necessary for T to prepare CFS? Yes. Then this exemption goes away. For this exemption, all the 4 conditions have to be satisfied, which I discussed with you. And if you want, you can draw reference to the same on page number 10.6 of the study material. All right? Yeah. All these conditions are mandatory. It's not one. All the conditions are mandatory. If any of the conditions will not be fulfilled, then T will have to prepare CFS. If these conditions are fulfilled, all, then T will get an option of not preparing the CFS if T wants. Okay, clear? Any more questions on this? Please let me know, then we'll move further. Okay, Ashma and Shameen are clear on this? Yeah? Sharon is asking, sir, can a company have 2 holding companies? No. Holding company can only be 1. It cannot be more than 1. It has to be 1 of these. Okay, now moving further, we will talk about a scenario where again, even though CFS will be prepared, but some of the subsidiaries may not get consolidated. Let's try to understand this situation. So we had this example of H. Let's suppose there are 4 subsidiaries: S1, S2, S3, and S4. As we discussed, CFS is mandated. For whom? This group. Who will prepare? H. For 5 entities. And 5 entities will be considered as single economic entity. Okay. But as per accounting standard number 21, now which accounting standard is this? So far, all the discussions that we have had and all the concepts that we are going to cover in relation to consolidation, where do they come from? Accounting standard and AS 21. So you can say currently we are discussing AS 21, except for certain principles which we picked from Companies Act in between. Okay. Now this accounting standard says that H will prepare consolidated financial statements, but some of the subsidiaries which fulfill following criteria, which I am going to discuss with you, will not get consolidated in the consolidated financial statement. So means H will prepare CFS, but in such CFS, some subsidiaries will get excluded. Let's understand which subsidiaries are those. You may also refer to page number 10.9 for this. Number 1, if there is a subsidiary for which control is acquired only for a temporary period, means subsidiaries held for disposal in near future. So for example, this is held for disposal in near future. So S1, even though is the company over which H has got control, say 85% shares of S1 are held by H. But what is the intent of H? Not to hold this investment, but to sell this in near future. Means this investment is temporary. In such a case, what will H do? H will prepare CFS, but in the CFS, S1 will not be consolidated. S1 will be kept away. Okay, clear? Now please remember that I am not saying that H will not prepare CFS. CFS will be prepared. The only thing is one of the subsidiaries will remain excluded. Now question may arise that, sir, let's suppose H doesn't have S2, S3, S4. H has got only S1. Will CFS be prepared in such a scenario? Because in such a scenario, only one subsidiary was there, which is not getting consolidated. So that's why question of CFS doesn't arise. Because for a CFS, holding and at least one subsidiary has to be here. Holding and at least one subsidiary has to be there. Otherwise, it's not possible. Clear? Number 2, if the subsidiary operates under severe long-term restrictions, if the subsidiary operates under severe long-term restrictions, which significantly impair its ability to transfer funds to the parent. So let's suppose S2 is another company. It is under severe long-term restrictions. So there are severe long-term restrictions on S2, because of which its ability to transfer funds to the parent, who's the parent H, is impaired. Here again, we will not consolidate S2. So you can say these two are the exceptions, or these two are the exclusions from the CFS. And where do these exclusions come from? These exclusions come from AS21. AS21 talks about these two exclusions. Clear on this? These two exclusions come from AS21. Okay. Clear? Yeah. All right. So I think we are now done with most of the principles in terms of setting up the base for the purposes of consolidated financial statements. I think we have done that. Now we will move on to the consolidation requirements. So you can say now we move on to the actual consolidation requirements, which we will be required to consider for the purposes of solving the questions also in the exam. So before we move on to that, if you've got any doubts up to this, please let me know. So any doubts in relation to whatever we have discussed so far, please let me know. Okay. Yeah, Aditya is clear on this. Very good. Okay, so let's move further. Now, whenever we will be required to solve the questions related to consolidation, we will be required to follow two approaches. Okay, so now, if you want, you can make the notes of these points. If you want, you can just understand some of these points, but these points are very, very important. And all of these discussions I have been doing from the study material only. Yeah, so you don't need to worry about taking the notes on this, but if you want, you can take the notes also. Huh? So I'm just picking some of the principles from this part of the study material. So let's now understand, how do we get a subsidiary? Say H acquire S. Definitely H will have to acquire S, or the other ways will be that S is incorporated. So what are the two ways of getting a subsidiary? Either H will create a new company wherein 100% shares are held by H, or majority of the shares are held by H, or H may acquire a running company or any company by getting majority shares of that company. So these are the two ways of getting this company. Let's suppose on a particular day, within the financial year 21-22. So which financial year is this? 21-22. And let's suppose it's 1st June. 1st June 2020. H acquired 100% shares of S. shares of S. Now, if you want, you can also relate some of those points to amalgamation. I'm sure you would have covered amalgamation by now. Am I correct or not? Amalgamation you have all covered or not? You can also relate to most of those points in terms of my discussion now. Now, what will happen? If H will acquire shares of S, so in a way it's a acquisition of a company, or you can say acquisition of a business. Correct? So what will come to H? A company, or you can say assets of S will come to H. Liabilities of S will come to H. Yes? Yeah? Or in other words, you can say net assets of S. Net assets of S will come to H. H is the holding company. In return for this, H will also be required to pay something. So what will H pay? H will pay purchase consideration. Say for example, H has paid 100 rupees. H has paid 100 rupees. And in return for this, H received net assets equivalent to 70 rupees. Net assets equivalent to 70 rupees have been received by H. So now in this scenario, what will happen? In this scenario, H has paid more than what's been acquired by H. So can you tell me what will happen in this scenario? How will you record this? If you look at the current scenario, H has paid more and got less assets. So how do you record this? What is the situation called as? I'm sure all of you would be knowing the answer. I'm waiting for a response quickly. How do you record this? Quickly. I'm waiting for a response quickly. How do you record this? Wherein H has paid more and H has got less. Great. Aditi, Sanjay and Manish, they are saying sir, goodwill account will be created of ₹30. Very good. So now this is a situation wherein goodwill will get generated equivalent to 30 rupees. Why? Because this excess consideration which has been paid by H is for what? Is for the goodwill only. Yeah. Let's suppose instead of 170, let's suppose if the value of net assets is 170, so H has paid 100 and has acquired a company having net assets of 170. So now it's the other way around. So in this scenario, do we get a goodwill? No. But definitely something has been paid and some recording has to happen. So now in this scenario, instead of goodwill, how do you record it as? This is recorded as a capital reserve. This is recorded as a capital reserve. Correct? So you can see a lot of your responses are Nakul, Shameen, Namrata, Narayana. They were all talking about goodwill. Yeah. So this other point is also, I'm sure, is something with which you are familiar. Capital reserve. So when the purchase consideration is less than net assets acquired, what do we get? Capital reserve. When purchase consideration is more than net assets acquired, what do we get? Goodwill. Clear? Clear on this? Yeah. Okay. So now, on this particular day, when the acquisition will take place, what will happen? Either the goodwill or capital reserve will have to be computed. Either the goodwill or capital reserve will have to be computed. So this is the first part which you have to remember. Whenever we will solve the questions of consolidation, you will always have to remember whether we are required to compute this or not. Okay? Clear on this? Number 2. Currently, we talked about a situation where 100% shares were acquired. Let's suppose instead of 100, 80% shares were acquired. Instead of 100, 80% shares were acquired. Okay. Now in this scenario, what will happen? 20% shares would be held by minority interest. So whenever we have partly owned subsidiary, in such a scenario, we will always be required to recognize minority interest. So on this date, along with capital or goodwill reserve, whatever be the case, one more working will have to be done. What is that called as? Minority interest. Clear? Clear on this? Now this is 31st March 2020. Okay, now all these things that we have discussed so far, what is the time point when you will compute these? On the date of acquisition. This is what? Date of acquisition. Okay. Now, H acquired S on 1st of June 2021. Okay. Now, can you tell me when should the consolidation start? I have two options for you. First April 2021, 1st June 2021. This is quite logical. Okay, so that's why I need all of you to answer. What do you think will be the date from which consolidation should start? Nishma says I didn't understand the minority concept. I have not discussed the minority concept as yet. So how will you understand it? I just told you that one working will have to be done. How is that working required to be done? We'll come on to that slightly later. Okay, so don't worry about it. So now you need to answer that whenever we have this situation we have got 2 dates from which consolidation may start. Consolidation, you understand, the preparation of consolidated financial statements. 1st April 2021, that means the beginning of the financial year. 1st June 2021, that is the date of acquisition of a subsidiary. What do you think will be the date from which consolidation should start? Quickly, over to you. Aditi, Gilbert, Namrata, Kushi, they are saying it should be 1st June. Oh, why 1st June? Why not 1st April? Can any of you tell me why it should not be 1st April? Jamil is saying 1st April because that would be the preparation before acquisition. Okay. Manish is saying date of acquisition. Rama, I think, has got a different point altogether. Shamim is saying 1st June. Okay. Now, please remember that when we are preparing the consolidated financial statements, we are not preparing the financial statements of one company. What are we doing? We are combining 2 or more companies within the group. Yeah. We are combining the group companies as if they are one and then preparing the consolidated financial statements. But when should we combine them? If you look at this period, 1st April to 31st of May, H and S were not the group companies. They were unrelated parties. H had no interest in S. They were not the group companies. S was not a subsidiary of H. So when can this consolidation be done? Only when H will have a subsidiary. And when did S become subsidiary of H? 1st June. So that's why, when should the consolidation start? When the control is acquired by H in S. Can it happen before that? No. You may have a question, but sir, financial year starts from 1st April 2021. Does it mean that we will not be preparing for the full financial statement, full financial year? The answer is yes. Consolidation is not something which is always required to be done for full financial year, even if the control is not there. No. Consolidation has to start from the date control is acquired. Okay? And up to which date this consolidation will continue? Up to the end of financial year. Next year again it will continue. So that means CFS will be prepared for this period from 1st June to 31st March 2022. From 1st June to 31st March 2022, CFS will be prepared. Okay, clear? And please remember, when the CFS will be prepared, on which date you will prepare CFS? Will you prepare CFS on 1st June? Will you prepare it during this period? Will you prepare it on 31st March? Over to you again. On which day CFS will be prepared? Rama has answered this. Very good. He is saying it will be prepared on 31st March 2022. That's correct. CFS will not be prepared on this date. Their preparation will start from 1st June. But on which date you will prepare the financial statements? At the end of the year. Similarly, CFS will be prepared at the end of the financial year. So on this date, CFS will be prepared. Now, what will happen? When you will prepare CFS on this date, now for the purposes of preparation of CFS, you will require 2 things. These, which will have to be computed first of all on this date, and then both of them will have to be remeasured on these dates. Both of them will have to be remeasured at the end of the year. Means goodwill, you'll remeasure at the end of the year. Minority, you'll remeasure at the end of the year. How do you remeasure? I'll come to it. But this is something you'll have to remember always, that you'll have to remeasure it at the end of the year. Yeah, so Kushi, Sharon, Shameen, they are saying yes. It should be 31st March 22. Okay. Great. So now we have discussed about the periods, etc. for preparation of financial statements. Now what can we do? We can pick up a small example. This example that we have on page number 10.15. Pick up this example on page number 10.15. Okay, example number 1. We will now get into this. Yes, H Limited acquires 70% of equity shares of S on 1st January 2000 X1. H acquires 70% shares of S on 1st January 2000 X1. On that date, paid up capital of S was 10,000 equity shares of rupees 10. On this date, paid up capital of S was 1 lakh. Correct? Paid up capital of S was 1 lakh. Accumulated reserve balance of S was 1 lakh. This was also 1 lakh. H Limited paid 1,60,000 to acquire 70% interest in S. So for getting this 70%, what did H pay? 1,60,000 has been paid. Yeah. Assets of S Limited were revalued. Now, on this date, assets of S Limited were revalued. And this resulted in a revaluation loss of 20,000. So there was a revaluation loss. 20,000. All these particulars are for S. Okay. Now, in this scenario, what do we need to do? If we have to compute the net assets of S or the net worth of S, how do we compute? We'll pick up its capital, its reserves, right? And the revaluation loss. This will also hit the reserves. So what is the net asset of S? Net assets of S. What do we have? It's 2 lakh less 20,000. 1 lakh 80,000. 1 lakh 80,000. Okay. Now, in this scenario, we are also required to check whether we will get goodwill or capital reserve in this. Now, This is the total net assets. So if you look at 1,80,000, what does it reflect? Total net assets. But whether H has acquired total net assets? No. H has acquired only 70%. So that's why 70% of this will go towards H. 70% of this will go towards H. And 70% of this will go towards H. So what do we get? 1,26,000. Now in this scenario, if you look at it, H has paid 1,60,000. So what is the purchase consideration? 1,60,000. And the net assets which have been acquired are 1,26,000. So what do you get in this scenario? Goodwill or capital reserve? Goodwill, because excess consideration has been paid. So if you pay excess consideration, what do you get? So this will lead to a scenario of goodwill. Okay? Clear with this? Yeah. Similarly, we can move on to next example. Example number 2 on next page. Example number 2. Okay. A Limited acquired 70% interest in B Limited on 1st of January X1. A Limited acquired 70% of B. Yeah. On that date, B had a paid up capital of 1 lakh. So this is B. Paid up capital is 1 lakh. And accumulated reserves are also 1 lakh. But on this date, when the revaluation took place, it resulted in a profit instead of loss of 20,000. So there was a revaluation profit. So the net assets of B therefore would become 2,20,000. If you look at the proportionate share, that will become 1,04,000. Correct? Yeah. Now, A Limited has paid 1,30,000 instead of 160. A Limited has paid 1,30,000. So let's see, do we get any goodwill or capital reserve? $1,30,000 and 1,50,000. So now, if you look at this scenario, we have purchase consideration lower than the net assets acquired. Purchase consideration lower than the net assets acquired. So what do you call this situation as? The one which is resulting into capital reserve. Okay. Yeah. Is that correct? The one which is resulting into capital reserve. So can you tell me the amount of capital reserve quickly? Can you tell me the amount of capital reserve quickly? Over to you. What will be the amount of capital reserve? So this will be capital reserve. This will be capital reserve. Yeah. Okay, great. So Manish, Shamin, Shakshi, Aditi, Kushi, they are getting the same answers. It's a capital reserve of 24,000. Yeah. $24,000 is the capital reserve. Okay. So we have discussed about the computation of goodwill or capital reserve briefly. Now, we will move further on to the consolidation principles. So let's now try to understand how do we consolidate. For the purposes of consolidation, a very simple procedure is required to be followed. What is that procedure? Line by line addition. Line by line addition of all the components of holding and subsidiaries financial statements. Let's see what does it mean. H is the holding company, S is the subsidiary. Say for example, in S, 90% of the shares are held by H. So that means 10% are held by other shareholders. So it's a case of partly owned subsidiary. Okay. So now let's understand when the consolidation will start. What is required? When the balance sheet will be prepared, so there will be various assets, liabilities. When the P&L will be prepared, there will be various items of H in terms of P&L. So now the consolidation principle, as per AS 21 says, that all the line items of H and S should be added together. Very simply, add them together. So what do we get? Total. So we'll add them together. All the line items of H and S, we will add. But certain adjustments will have to be made in this. What are those adjustments? Number one, certain adjustments. Number one, H and S may be having intercompany transactions. Means there could be transactions between H and S. What do we need to do? Eliminate. Eliminate intercompany transactions. Okay. What could be the other adjustment? Now, if you look at the scenario of consolidation, in the consolidated financial statements, H has picked up 100% shares of S. 100% assets of S. Who has picked up? H. 100% liabilities of S. Who has picked up? H. 100% reserves of S. Who has picked up? H. But can we say that 100% interest of S is held by H? The answer is no. 10% interest is held by other parties, which is a minority. But this entire 100% has been picked up by H. So what should H do? In its financial statements, H should show 10% share of the minority which doesn't belong to H, as if it's a liability of H. I'm repeating my point. In the consolidated financial statements, what will happen? Let's suppose this is the consolidated financial statements, and we are looking at the balance sheet. So if you look at this balance sheet after elimination, etc., what will you see? You will see some assets, you will see some liabilities, you will see some reserves. But those reserves, those assets, those liabilities, can we say that in their entirety they belong to the group? No, because 10% part of those balance sheet items, those reserves, those P&L items belong to whom? These minority companies. So that's why in the financial statements, what should the group do? Group should say that this 10% which I have consolidated doesn't belong to me, and which should therefore be shown as a liability. In a way, yeah. So this 10% clubbed together has to be computed as if it's something which is belonging to the minority interest, and which is required to be shown separately on the face of the balance sheet. So that's why whenever all of these adjustments will have to be made, what is additional adjustment which will have to be computed? Minority interest. In case of a partly owned subsidiary, minority interest will have to be computed, and that will have to be shown separately. Yeah. And can you now understand? Because I got one query from one of you that, sir, I couldn't understand the concept of minority interest. So this is the concept of minority interest. How is that minority interest required to be computed? We'll get on to those computations also. But please understand that why is this required to be computed, and where is this required to be presented in the financial statements? I'm repeating, the approach that we follow for consolidation is called as line by line addition, wherein all the assets, all the liabilities, all the P&L items, all the reserves for subsidiary are picked up by holding on a 100% basis. Even though some portion of this doesn't belong to holding, still this approach has to be followed. Now, because this approach is followed, so that's why in the consolidated financial statements, the 10% share which doesn't belong to the group has got incorporated. So what do we need to do? We need to show to the outside world that this 10% is not the one which is belonging to the group. So that is shown by keeping this 10% in the form of minority interest, which is presented on the face of the balance sheet separately. Clear? Clear on this? Yeah? Okay, I think Suprada is facing some video problem. I think you need to check your connectivity, please. Shamim is saying some minority interest is shown in the notes to accounts. See, that is about a disclosure. You don't need to get into the disclosure. Huh? Nishma has understood. Very good. Any more questions, any more doubts in case you have on this, please let me know. Because with this, we have understood some of the concepts which are involved. And now we will move on to one illustration of this. So we will now get on to the computation. But I think we'll take a break. Yeah. So after the break, we will pick up example number 3, which is on page number 10.18. So in case some of you want to solve it on your own, you can also do that. Yeah. So we'll take a break now. So Manish is asking, it's like creditor of company. Yes, you can say that. You can say that. So it's like because we have picked up part which is not belonging to us. So that's what we are showing that this part which has been incorporated by us, which doesn't belong to us, is reflected in the form of minority interest, wherein the entire amount of minority interest is computed. And we'll get to understand about it when we'll solve some of these questions. So now we'll get on to the computation of this. Then we pick up this example number 3. Okay. Any more questions, doubts? So you can just post your queries and let's take a break now for 10 minutes. So after the break, we will continue with this example number 3. All right. Can we start? So whenever you will say. Alright, so welcome back. So we can now continue with our discussion. So let's move on to example number 3. Okay. So let's move on to example number 3 on page number 10.18. H Limited acquired 16,000 equity shares of ₹10 each in S on 1st of October for 3,06,800. Shares of S Limited. This is 1st October 2000 X1. Okay. P&L of S Limited showed a balance of 10,000 on 1st April X1. So if we go back on 1st April 2000 X1, P&L of S was 10,000. Okay. Plant and machinery of S, which stood in the books at rupees 1,50,000 on 1st of April was considered worth rupees 1,80,000 on the date of acquisition. Plant and machinery 1,50,000 on this date. So which means there was a revaluation of plant and machinery. Correct? Then we have some more information about these two companies as at the year. On 31st March X2, additional information is available about both the companies, H and S. Their share capital, their general reserves, P&L balance, their liabilities, assets. Yeah. In this case, if you look at the amount which H has paid to acquire S, is what 3,06,800. Purchase consideration. Yeah. Now, if you look at the percentage of holding, 16,000 shares are held by a holding company out of 20,000 shares, which means 80% shares are held by a holding. Who is the holding? H. So H holds 80% shares. So it's a case of partly owned subsidiary. So that means 20% shares are held by minority interest. So what would it mean? It would mean that on this date, this is the date of acquisition. On this date, we will be required to compute minority. We will also be required to compute goodwill or capital reserve. And both these things will have to be recomputed on this date. Correct? Clear on this? Yeah. Okay. So let's understand the impact of revaluation of plant and machinery. What is the book value of plant and machinery on 1st April X1? 1,50,000. On which, if we charge depreciation, so now in this case, do we have some information about the plant and machinery? Yes, this has got revalued to 1,80,000. This has got revalued to 1,80,000. Now, depreciation rate has been considered as 10%. So we need to charge depreciation at the rate of 10%. But 10% will be computed proportionately for 6 months. So if you charge depreciation at the rate of 10%, so it becomes 15,000. But for 6 months, it will become 7,500. So what will be the depreciation charge for 6 months? 7,500. Now the WDV, or you can say the book value of plant and machinery on 1st of October should be what? Should be 1,50,000 less 7,500. It should be 1,42,000. Alright, but the revalued amount is 1,80,000. On 1st of October, when this plant and the machinery got revalued, what was its value? 1,50,000. So what is the gain that you see? Clearly there is a gain, but from where you will compute the gain? From this original value or the WDV? From the WDV only. The book value should have been 142,500, but it got revalued to 180. So what is the revaluation profit? That is 7,500 is the revaluation profit. That is 7,500 is the revaluation profit. Okay. Yeah. Now, in this revaluation profit, which is a kind of reserve. Yeah, it's a kind of reserve. A portion is held by H and a portion is held by M. What is M? Minority interest. So we can say share of H in revaluation profit. Share of H in revaluation profit is what? 80%. Yeah, 80%. So this becomes 30,000. Share of minority in revaluation profit 7,500. Okay. Now additional depreciation which needs to be charged on appreciated value. Now if you look at this value of plant and machinery, this is now 1,80,000. Okay. This is what? 1,80,000. It is not 1,50,000. Now, why is this required to be assessed? If you look at the information which is available about these two companies, H Limited and S Limited, please remember that this information is in the context of standalone financial statements. This revaluation was done because H acquired S Limited. And when H acquired S Limited, at that point of time, shareholders of S Limited will say that even though this book value is 142, its market worth is 180. So that's why shareholders of S would want H to pay more for this plant and machinery. Understood? Yeah. But does it mean that in the standalone financial statements of S, this plant and machinery will get recorded at 1,80,000? No. So this plant and machinery will continue to be recorded in the financial statements of S at 140. But for the purposes of consolidation, this value will have to be looked at as if it's 180 instead of 142,500. That is also called as consolidation adjustment. Clear? Clear on this? Okay, so now coming back to the question. Now, if you look at the question, it provides us information at the year end. And this information also contains the balance of plant and machinery as at year end. But can we go with that balance of plant and machinery as at the year end? No. Because if you look at the information which is available in the question, it says plant and machinery as at 31st March X2 for S Limited is 1,35,000. And how was this computed? Simply by charging depreciation at the rate 10%. So 1,50,000 less 10% is what? 135. Correct? So it shows that the adjustment for this revaluation has not been incorporated in this closing balance of plant and machinery of S Limited. Clear on this? So now this adjustment has to be done at the time of consolidation. That is the one on which we are working right now. Okay. Yeah. So let's see what all adjustments will pass. Just give me 1 minute. Okay, so now what do we do in such a scenario? We will have to compute the additional depreciation which needs to be charged on this. So let's compute this additional depreciation which needs to be charged on this. Or if you have computed, you can just start sharing that information with me. So additional depreciation on plant and machinery of S. Okay. What is that amount? 10% will be charged on 1,50,000. On 1,50,000. And 10% will be charged on 1,80,000. Yeah. So this is the total amount which needs to be charged, less the amount which is already charged for full year. That is 15,000. How do you get it? Because we have this 1,35,000 as against opening balance of 150. Correct? So now, what is the additional depreciation which needs to be incorporated? 1,500. This is an additional charge which has to be taken care of. And because it's a charge, so what will happen? This will reduce the reserves. This will reduce the reserves. Yeah. And who will bear this charge? This charge will again be borne by two parties. Who are those two parties? H and the minority. So what do we do? Now, we will compute share of H in additional depreciation. What is going to be that amount? 1,500 into 80%. 1,500 into 80%. 1,200. And share of minority in additional depreciation. Clear? So when we'll prepare the balance sheet, when we'll put down this information, you'll understand that all of these points will have to be incorporated over there. Yeah. So you can just say that these are some of the consolidation adjustments which one has to take care while preparing the consolidated financial statement. So now, before I move further, let me just go to your queries. Any questions, any doubts in case you have on this, please let me know. Shamim is asking, sir, how did you get this minority interest revaluation profit? So 80% goes to this H, 7,500 balance amount. Out of this 27,500 goes to minority. That is how it's been computed. Quickly, any more questions? I think Manish solved this. 16,500. So I'm not sure where was this information required, but anyways, Manish, if you have any questions, you may let me know. Yeah. Any questions, any doubts on this? So in that example, we just try to look at some of the adjustments which will be required to be done. And within that adjustment, what will be the share of holding? What will be the share of minority? Okay, clear? So do we move further? Quickly on. Do we move further? All right, so let's go to this page number 10.20. We will now be discussing the adjustment in relation to dividend. And before this adjustment related to dividend, there is another concept that I will touch upon. So H acquired S on this. You can say this is also the date of acquisition. Correct? Something we have already talked about. Please remember that this date is very, very important. Why? Because certain adjustments are required to be done on these adjustments. We have already talked about it. Minority interest has to be computed on this date. Number one. Goodwill or capital reserve has to be computed on this date. Yes. This requires, so you can say computation of these two things requires bifurcation of reserves of the subsidiary into two parts. This period is called as pre-acquisition. This period is called as pre-acquisition period. And this period is called as post-acquisition period. Okay, yeah. This is pre-acquisition and this is post-acquisition. Now, whenever you have any information available in the question, you will always need to remember that all the reserves, all the profits of the company need to be bifurcated into two parts: pre-acquisition and post-acquisition. Because depending on this segregation, the computations of minority interest, goodwill, capital reserve, etc. will vary. Okay, yeah. Okay. Now coming back to the adjustment which we are now going to discuss, which is also dependent on whether the profits are pre-acquisition or post-acquisition. Let's understand. This is about dividend. Say for example, H has acquired S and S pays dividend. Or you can say dividend which is received from S. What will be the accounting treatment of this dividend? In the books of H. We are not talking about books of S. We are talking about books of H. Or you can say we are talking about consolidated financial statements. In case we understand from the information given in the question that the dividend is declared by the subsidiary out of post-acquisition profits. In case this is declared by the subsidiary out of post-acquisition profits. So in this case, what will happen? H will record this as if it's its income. H will record this dividend as if it's its income. Okay? Yeah. Simple and easy to understand. How do you record dividend income? How do you record dividend income? Simply, it goes to the P&L of the receiving company or the investor. So is the investor here? H. So H will record this as income. But that will be recorded as income in case it is coming from post-acquisition profits. Let's now quickly look at the books of subsidiary. It is not required, but still, let's quickly look at the books of subsidiary. In case it is post-acquisition dividend, now I'm going to this flow chart, which is given on the page number 10.20. You can also follow this flow chart. No adjustment is required by subsidiary. This is something which is adjusted at the time of consolidation. Okay. Now, when do you say this is adjusted at the time of consolidation? Because subsidiary will pay this, holding will receive this. So in a way, this is an intercompany transaction which gets eliminated. Yes or no? Yeah. I think the problem arises. Rather, I should not call this as a problem. I think the place where you need to be careful is the one wherein the dividend is declared out of pre-acquisition profits. For this, we need to go back to your understanding of Accounting Standard 13. Remember, Accounting Standard 13. Yeah, Accounting Standard number 13. I'm sure you would have covered it. So in case any dividend is declared out of pre-acquisition profits, how will the holding record it? Will that be recorded as an income? No. That will be reduced from the amount of investment. What is the amount of investment in our case? It's the purchase consideration. It's the cost of acquisition. Understood? Yeah. So these two adjustments you need to remember whenever we will be discussing about the dividend, whether it is declared out of post-acquisition or pre-acquisition. Now, we will pick up this small illustration. I think through this we'll get some more clarity in terms of computation of some of these amounts that we have discussed. All right, so you can all move on to illustration number 1. Yes, quickly. If you can move on to illustration number 1, please. All of you can move to illustration number 1. From the following data, determine in each case. So we have got few cases. Case 1, 2, 3, and 4. So we have got 4 scenarios. In all of these scenarios, we are required to compute minority interest at the date of acquisition, then at the date of consolidation. What is the date of consolidation? Year end. Goodwill or capital reserve. Amount of holding company's profit in the consolidated balance sheet, assuming holding company's own P&L to be 2 lakh in each case. Now please remember this. And please understand what is this third point. Huh? Say we have a holding, we have a subsidiary. Yeah? And the consolidation has started. When the consolidation will start, so holding will have a reserve. Subsidiary will also have a reserve. Let's suppose reserve of holding is 2 lakh. And reserve of subsidiary is 10 lakh. Now they are saying that when you will consolidate, okay, in the consolidated financial statements, holding will pick up a share of this. Holding will pick up a share of this. Why? For consolidating in the consolidated financial statements. Wherein share of holding at a standalone level means share of holding in its standalone financial statements is what? 2 lakh. In fact, it does not share the amount of holding companies paid. Okay, understood this third point? All right, so let's look at these case. Case 1, 2, 3, 4. So we have got 4 subsidiaries. Subsidiary A, B, C, D in 4 scenarios. In the first scenario, holding company holds 90% shares. The cost of acquisition was 1,40,000. Date of acquisition in all the scenarios is same, but the information about share capital and P&L of A, B, C, or D as on the date of acquisition and on the date of consolidation are different. Okay, clear on this? Okay, so now what do we do? So first of all, let's compute the minority interest in all the 4 scenarios. You can also start solving this on your own, and you can just start sharing your responses. Huh? Manish is asking, sir, it is deducted from the cost. He is asking about the dividend. Yes. Very good. Okay, so now moving on to the minority interest computation. So we have case scenarios. Case 1, 2, 3, 4. Yeah. Minority percent. So 10%, 15%. The third one is 20%. The fourth one is nil. Okay. Now, on the date of acquisition, what will be the percentage share of minority? Let's understand. Whatever is the net asset of subsidiary company, 10% of that belongs to who? Minority. So what are the net assets? On the date of acquisition, 1 lakh plus 50,000. 1 lakh plus 50,000 into 10%. This belongs to whom? Minority. So that means 15,000 will be the share on the consolidation. So date of consolidation. On this date, what is the amount of net assets? 1 lakh plus 70,000 is 1 lakh plus 70,000 into 10%. So this becomes 17. Clear? Simple and easy to compute. Yeah, simple and easy to compute. All of you. Yeah. Similarly, can you give me the answers for case 2, 3, and 4? In the fourth one, when the percentage of minority is nil, so what will happen? This will become nil and this will also become nil automatically. Yeah, this will become nil and this one will also become nil. Clear? Easy. So for case 2 and case 3, can you give me the numbers? Sharon will discuss this third point when we'll solve it. Okay. For the time being, I think you should start computing the one that we have been doing. Okay, Sakshi has solved this. Sakshi is saying 15,000, 19,500 and 14,000. Very good. So this is 19,500. This is 14,000. Understood how you need to solve this? This is 18,000 and this was 14. Great. So minority is solved, and you can also see why is the minority changing. On the date of acquisition, minority was 15,000, but as at the year end, minority has changed by because the net assets have changed. If the net assets will change, automatically the amount of minority will change. Clear? Clear on this? Okay, now moving on to the next requirement. We need to compute the amount of goodwill or capital reserve. Yeah? We need to compute the amount of goodwill or capital reserve, whatever be the case, in all of these scenarios. 1, 2, 3, 4. Goodwill or capital reserve. So here again we'll go case by case. Case 1, 2, 3, 4. In the first scenario, what's the percentage shareholding? Now, do we need to look at the minority percentage? No. We need to look at the majority percentage. Why? Because goodwill or capital reserve will be required for majority only. So this is 95%, this is 85%, this is 80%, and this is 100%. Yeah. Then we need the cost of acquisition, or you can say the amount which has been invested. So cost of acquisition. It is again given in the question. 1,40,000. This is 1,04,000. This is 56,000. Fourth one, 1 lakh. Okay. Next information that we need is about the total equity. Yeah. So we understand that the total equity of subsidiary. Total equity, or you can say total net assets of subsidiary. In the first scenario, what is that amount? 1 lakh plus 50,000. We are computing this on the date of acquisition. 1 lakh plus 50,000. 1 lakh 50,000. This is the amount of total net assets of the subsidiary. Out of this, what is the portion of the parent? Percentage of holding in equity of S. What is the percentage of holding in equity of S? %90, correct? So this becomes 1,35,000. How do we get 1,35,000? This into this percentage. 1,50,000 into 90%. Clear? Yeah. So now purchase consideration is 140 and the net assets acquired are 135. So what do we get? Goodwill or capital reserve? What do we get? Goodwill or capital reserve? So if it is goodwill, we'll keep it positive. If it is capital reserve, we'll keep it negative. Yeah. So in this scenario, do we get goodwill or capital reserve? 140 minus 135, 5,000. It's the goodwill. It's goodwill. Clear? Yeah. Now let's move on to the second one. In this case, total equity is 1,30,000. And 85% of this is the portion of holding. So this is 1,10,500. So now 1,04,000 has been paid, acquired is 1,10,500. So what do we get? Negative goodwill, 6,500. This is negative. Yeah. Or we can say this is capital reserve. Clear? Clear? All of you? Okay, moving on to the next one. This is 70,000 is the total. And 80% of 70,000, 56,000 is the portion of holding. So paid is 56,000 and net assets which are acquired because of this are 56,000. So do we have any goodwill or capital reserve? No, it's nil. There's no goodwill or capital reserve. Clear? Clear on this? Yeah. So in this case, total equity, last one, 90,000. And this will remain 90,000. So 1 lakh has been paid to acquire 90,000. So what do we get? 10,000. And what is this 10,000? 10,000 is the amount of goodwill. 10,000 is the amount of goodwill. Clear? Clear on this? Any questions, any doubts up to this? Please let me know. I can see a lot of your responses and Sanjay has answered this. Very good. So Nishma has also solved. Great. Kuluru has computed the amounts. Great. Nakul, Anantraman have computed. Sharan, I think is not very clear in terms of your query. Sanjay seems to have computed the goodwill amount. All great. So your amounts are absolutely correct. Very good. So let's move on to the third part now. Third part, if you have already solved this, you can just start sharing your responses. And Nishma is very clear on this, which is great. Yeah, so we can move on to the third part now. So in the third part, what do we need to compute? Percentage of holding company's profit. Percentage of holding company's profit. And this will be computed as at the year end. Yeah. So again, we have 4 scenarios and we have percentage shareholding. So we'll keep it same. Now these things change. Okay, so now what do we do? First of all, we pick up the profit or loss on the date of acquisition. Now, do we need to pick up the share capital? No, because now we are dealing only with the profits during the year. So, P&L on date of acquisition, 50,000. This P&L is of S. And then we'll pick up the P&L of S on the date of consolidation. P&L on date of consolidation. Yes. So what do we do? This is 70,000. Okay. So what are the post-acquisition profits? Post-acquisition profits. 20,000. 20,000 is the amount of post-acquisition profit. Okay. So which means during the year, subsidiary has earned 20,000. Why? Because its opening balance was 50,000, its closing balance is 70,000. So during the year, what has it earned? 20,000. Okay. Now please remember that out of this 20,000, 10% belongs to whom? Line audit. And 80% belongs to whom? Majority. So if we have to compute the share of profit of the holding, so what do we do? Share of holding. That will be 20,000 into 90%. So this becomes 18,000. 18,000. Clear? Simple and easy to do. Yeah? Simple. Similarly, next one. So 30,000 was the opening profit. In the closing, it got reduced to 20,000. So that means during the year, there is a loss of 10,000. Yeah? So loss proportion equivalent to 85% goes to whom? Holding. Moving on to the third one. So 20,000 was the opening balance. 20,000 is the closing balance. Do we have any profit or loss during the year? No. So any portion of profit or loss that we go to the holding, nil. It will be nil. In the fourth scenario, opening profit was 40,000. Closing P&L balance is 55,000. So that means profit has increased by 15,000. So we can say reserves have increased by 15,000. And all of these reserves belong to whom? Holding. So these 15,000 reserves belong to the holding company. Clear? Clear on this? Any questions? Any doubts that you may have on this? Please let me know. Quickly, any questions, any doubts that you may have on this? Please let me know. Sharon, I'm hoping you are clear on this because you had a doubt on this point number 3 as to what is required to be computed. So I think moment you understand as to what is required to be computed, you must have understood because its computation is not simple. It's not difficult. It's very, very simple. In fact, easiest out of all 3. Yeah, correct. So any questions, any doubts that you may have on this, please let me know. All of you. Any questions, any doubts? No? All right. So what you should do now is you should mark your homework. You should try to practice illustration number 2 and 3. So these 2 illustrations you should try. See, some of these points in this illustration or any of these illustrations may bother you. Why? Because even though we have discussed the concepts which are going to be used in these illustrations have been discussed. Okay, so we have discussed, but still we have not solved each and every point. So that's why it may bother you, but I would suggest you practice this. Anyways, we'll see as to where you are facing any problem and we will also solve all of these in the class also, in the next session. Okay, clear on this? Yeah. Okay, so now moving on to your queries. Okay, I think Shamim is clear on this. Very good. Okay, Nishma is also clear on this. Very good. Sharon is also clear. So Sharon doesn't have any doubts anymore. All right. So I think with this, I'm not taking it up any further because we are almost done and we are towards the end of our session today. And anyways, the next session is quite big and the next concept also we need to pick up. So in the next session, we'll pick up the remaining part. But over and above this homework which I have given you, it is very, very important that you revise everything that we have discussed today before we meet next. Because we are going to pick up from where we are leaving today. Yeah. So it's very, very important. It's very, very important that you revise whatever we have discussed. Yeah. Only then we will be able to continue to appreciate all of these concepts that we'll discuss in the next session. Okay. So Jamil is asking, sir, clear, but one thing, please explain what is the question asking all about. I understood the answer, but not the third question. So the third question is saying, what's the share of holding in the profit of subsidiary? That's the third question. Simply. And that is what we have solved. Okay. Shamim has found this interesting, very good. So I'm hoping that all of you are finding this interesting and you're finding this concept to be simple, and that is going to be our agenda now. All right. So with this, we can just end our discussion over here. If you're still left with any of your queries, just post down. Yeah, and we can pick up any of your queries in the next session also. All right. So thanks to all of you for your time and for your wonderful participation today. Thanks so much.